Financial freedom is one of the most sought-after goals for anyone who recently starts earning. More than 70% of the Indian working class is trapped in a repetitive, unfulfilling and stressful work routine that feels like a never-ending cycle. Now, this is not what the video is for. There are many videos on YouTube that advise why financial freedom is important. But we are here to answer a fundamental question. How can an average Indian invest those first 10,000 rupees for maximum returns? So stick till the end because this video is a blueprint on how to start investing efficiently and how to make the most out of that first investment. Number 1, start with a plan. Everything starts with a plan. Identify your investment goals, risk tolerance, and time horizon. This will help you determine the right investment strategy for you. Now, there can be different strategies depending on your goals. For example, your plan can focus on investing for dividends by getting those stocks with a rich dividend history. Similarly, you can have the plan to invest for growth. And on the other hand, you can also invest in some blue chip stocks for some long-term growth. With that being said, the next step is to select the stocks you want to go for. Number 2, invest in blue chip stocks. For those of you unaware, blue chip stocks are high-quality companies with a proven track record of stability and growth. Examples of blue chip stocks in the Indian market include Tata Consultancy Services, TCS, HDFC Bank, and Reliance Industries. Now, let's suppose that you are planning to invest 10,000 rupees. Calculate the number of shares to buy, divide your investment amount, which is 10,000 rupees, by the current market price of the stock to determine the number of shares you can buy. For example, if the current market price of the stock is 1,000 rupees per share, you can buy 10 shares. But the next step is perhaps the most important step in your journey to financial freedom. Number 3, diversify your portfolio. Diversification is key to managing risk and maximizing returns. Consider investing in a mix of blue chip stocks from different sectors, such as banking, IT, and consumer goods. By investing in a mix of stocks from different sectors and industries, you can potentially reduce the impact of a downturn in a single sector or company. This helps to manage overall portfolio risk. Diversifying your portfolio can also increase your potential for higher returns by providing exposure to a wider range of growth opportunities. Now, it goes without saying that different sectors and industries tend to perform differently in different economic conditions. By diversifying your portfolio, you can potentially balance out the volatility of individual stocks and sectors. Diversifying your portfolio can also help align your investments with your personal financial goals and risk tolerance. For example, you may choose to allocate a larger portion of your portfolio to less risky investments if you have a shorter investment horizon, or to more risky investments if you have a longer investment horizon and a higher risk tolerance. An example of a diversified portfolio is one that includes large cap, mid cap, small cap, dividend stocks, and even growth stocks to mitigate risks. Now, some of you might ask the question, how can we diversify our portfolio to the maximum? By simply investing 10,000 rupees? This is the reason we want you guys to look into those index funds. Number 4, investing in index funds. To put the long story short, start investing with index funds. Index funds are a good starting point for new investors as they provide exposure to a broad range of stocks and reduce the impact of individual stock performance. Let's say you have decided to invest a lump sum of 100,000 rupees in index funds in India. After researching the available options, you have decided to invest in the Nifty 50 index fund offered by XYZ Mutual Fund. The Nifty 50 index fund tracks the performance of the Nifty 50 index, which is composed of 50 of the largest and most liquid stocks listed on the National Stock Exchange NSE of India. There are 2 ways you can actually make the payment for investment: SIP and lump sum. For those of you unaware, SIP, or the Systematic Investment Plan, allows you to invest a small sum periodically, and that too at a fixed profit rate through mutual funds. On the other hand, the lump sum method is more like a one-time thing, investing a large sum. Index funds provide a stable option for your investments along with providing relevant exposure to your portfolio. But when you're investing at a small scale, consistency is the name of the game. Number 5, dollar cost averaging. Consistent investing in the Indian stock market can be demonstrated through a strategy known as dollar cost averaging, DCA. This strategy involves investing a fixed amount of money in the stock market at regular intervals, regardless of the market conditions. This approach helps to average out the cost of investment over time and can reduce the impact of market volatility. Let's just look at an example to understand this strategy. Suppose you decide to invest 10,000 rupees in the stock market every month. In the first month, let's say you just invest 10,000 rupees in a stock when the market is high. The stock is priced at 1,000 rupees per share, so you're able to purchase 10 shares. In the second month, the stock market has declined, and the stock is now priced at 900 rupees per share. You still invest 10,000 rupees and are able to purchase 11.1 shares. This process continues for several months, and you're still investing the same amount of money every month, regardless of the market conditions. As a result of this consistent investing, you're able to average out the cost of your investment over time and reduce the impact of market volatility. You will end up purchasing more shares when the market is down and fewer shares when the market is up, which can help to reduce the overall cost of your investment and provide you with a better long-term return. Now remember that this is not a get-rich-quick scheme, where you invest a certain amount and get rich over time. Everything depends on the conditions under which you decide to invest and the profit rates you're getting. But the real game begins when you get that snowball rolling. When you invest those first 10,000 rupees, let the compound profit do its thing. Number 6, compound profit. Once you start investing consistently, compound profit, also known as the biggest wonder of the investing world, takes over. Compound profit is important for investors because it can help their money grow faster over time. When profit is compounded, it is reinvested into the investment, leading to the growth of both the original investment and the profit earned. This means that the profit earned in one period can generate additional profit in the next period, leading to exponential growth over time. For example, if an investor has a long-term investment horizon and invests a lump sum of money in a high-yielding investment, the compound profit earned over time can significantly increase the overall value of the investment. This can help the investor reach their financial goals, such as saving for retirement faster and more efficiently. Compound profit is particularly beneficial for investors who start investing at a young age, as it provides more time for their money to grow. The earlier an investor starts investing, the more time they have to take advantage of compound profit, which can lead to substantial gains over the long term. Let's say an individual invests a lump sum of 100,000 rupees in a stock that offers an annual return of 10%. After the first year, the investment would be worth 110,000 rupees, which is 100,000 times 1.10. In the second year, the profit is calculated based on the new value of the investment, which is now 110,000. The investment would then be worth 121,000 rupees, which is 110,000 times 1.10. In the third year, the profit is calculated on the new value of 121,000, leading to an investment worth 133,100, which is 121,000 times 1.10. As you can see, the profit in each subsequent year is calculated based on the previous year's new balance, leading to a growth in the investment value over time. This is known as compound profit, a wonder of the investing world. Remember, once you get that snowball rolling, the journey usually gets easier and faster. Investing your first 10,000 rupees in the stock market can be a challenge for those looking to make some money in the stock market. But these challenges usually become easier if you follow the above-mentioned steps. Let us know about your investing plans in the comment section below. When are you starting your investing journey? And what investing strategy are you going for? Let us know below in the comment section. Make sure you press the like and subscribe buttons, and we'll see you guys in the next video.